Aloha, welcome Inspired Moneymaker. Thanks for tuning in. If this is your first time here, welcome. If you're returning, welcome back to Inspired Money, where we explore how money can be more than just a number on a statement. It can be a powerful tool for change. Lately, more and more investors are not just asking, what's my return? They're asking, what's my impact? And that's where sustainable investing comes in. Aligning your financial goals with your personal values so your dollars work for you and for the causes that you care about. We'll look at the full spectrum, from avoiding industries that do not match your ethics to actively backing innovations in clean energy, sustainable agriculture, and beyond. We'll talk about real-world trade-offs, the tools to measure impact, and yes, whether sustainable investments can actually outperform traditional ones. After decades of federal action to curb climate risks, the U.S. Environmental Protection Agency now proposes to strip its own power to regulate greenhouse gases. So where do we go from here? Stay tuned because we have an incredible panel ready to share their insights. Before we introduce today's experts, I want to thank today's sponsor. This episode of Inspired Money is brought to you by my financial advisory firm, Runnymede Capital Management, where investing is never one size fits all. For over 30 years, we've worked closely with clients like you to understand your goals, objectives, and values. Then we create a customized portfolio designed to align with what matters to you, whether that's pursuing growth, protecting your wealth, or investing in a way that reflects your principles. At Runnymede, we specialize in both investment management and financial planning, providing a comprehensive strategy tailored to your needs. Our team combines rigorous research with a forward-looking approach to help you achieve your financial goals with peace of mind. If you're ready for a personal, thoughtful approach to money management, visit runnymede.com. That's RUNNYMEDE.com. Runnymede Capital Management, invest with purpose, plan with confidence. As with all investments, your capital is at risk. Past performance does not guarantee future results. And consulting with a qualified financial advisor can go a long way to determine what's right for you. Now let's meet today's expert panelists. Our first guest is Andrew Behar, a trailblazer in values-aligned investing. As CEO of As You Sow, he's taken shareholder advocacy to new heights, holding companies accountable on climate, social justice, and corporate governance. A former entrepreneur and inventor with 5 patents to his name, Andrew literally writes the guidebook on making your money matter, author of the Shareholder's Action Guide and a purposeful 50 changemaker. Andrew, welcome back to Inspired Money.
Hi, thank you for inviting me back.
Next, we welcome in Marilyn Waite, Managing Director of the Climate Finance Fund. She's steering billions toward a low-carbon future. She's worked across 4 continents in clean energy, sustainable investment, and climate policy, authored Sustainability at Work, and is one of the most respected voices linking global finance to real climate solutions. Marilyn, welcome.
Hi, Andy. Thanks for having me.
We have Jennifer Coombs, who is shaping the very language of sustainable investing as head of content and development at USSIF, the Sustainable Investment Forum. She's created the first U.S. professional credential in sustainable finance, the Chartered SRI Counselor designation. She's a 2-time TEDx speaker, 40 under 40 honoree, and passionate educator. Jennifer's on a mission to arm the next generation of financial leaders with ESG expertise. Welcome, Jen.
Thanks, Andy. Good to be here.
And rounding out our panel today, we have Loannis Loannou, Associate Professor at London Business School and one of the world's most cited experts on corporate sustainability. His award-winning research and work with boards, CEOs, and global institutions redefine what it means to lead responsibly, making him a sought-after advisor to companies shaping the future of business. Loannis, so glad that you're here.
Thank you very much for having me, Andy. Pleasure to be here.
With this panel of experts, we are in for an informative, inspiring conversation. Let's get right into it with segment 1.
Sustainable investing takes many forms, each with distinct strategies and trade-offs.
Negative screening avoids industries that conflict with ethical standards like fossil fuels or tobacco, ensuring investments align with specific values. Positive screening takes a different approach, selecting companies that lead in environmental, social, and governance performance within their industries. Thematic investing focuses on broader trends, channeling capital into areas like renewable energy or sustainable agriculture. Impact investing goes a step further, targeting measurable social or environmental outcomes alongside financial returns. While these strategies offer ways to align investments with personal or institutional values, they come with trade-offs. Exclusionary approaches may limit diversification, while impact investments can face challenges in measurement and scalability. Understanding these frameworks helps investors make informed decisions about where financial goals and sustainability priorities intersect.
Andrew, give us some context of where we are today, from the withdrawal of the US from the Global Paris Agreement to the EPA launching the biggest deregulatory action in US history. Where do investors stand when deciding about sustainable investing strategies?
Well, I think first you got to separate a lot of the rhetoric from what's actually going on. You're hearing from the administration that, for instance, people do not want diversity in their companies, and yet we had 24 votes of 99% of shareholders telling executives and boards, we want you to continue diversity in the workforce because we know it leads to outperformance. A diverse team is going to outperform. And so you got this contradiction where you got this narrative voice from the right that is so loud, the megaphone is so loud, that is just contradicting what we're seeing in real terms, which is that investors actually want greater diversity at their companies. And then you're seeing the companies, you keep, like you read, just there's a report, an article a couple of days ago that they use the word DEI program slashed. And I wrote to my team, I said, what is this slashed? This just sounds like some sort of, summer slasher movie. And they're like, no, well, a few companies have renamed, like JP Morgan, they don't call it DEI anymore, diversity, equity, inclusion. They call it diversity, opportunity, and inclusion. But they're still doing it because they know they want to outperform. So, and on climate, similarly, you're seeing a lot of companies, there's executive orders that they're trying to stay within. And yet they also know that climate risk is investing risk. Climate risk is supply chain risk. And so the better management teams are addressing these risks, even though they're being told, ignore risk.
Marilyn, you worked on multiple continents. You're outside of the US. Do you agree with that assessment? And do you think impact investing is reaching sufficient scale to shift capital flows meaningfully?
Thanks, Andy. I absolutely concur with what the other Andy just said. There's no stopping sustainable investing. Now, there is a spectrum when it comes to investing that seeks financial returns only, all the way to investing that seeks environmental and social impact returns only, right? Which is traditional philanthropy. And in between both of those ends, we have responsible investing, sustainable investing, ESG integration, and impact investing. And so we really have to clarify what is the thesis of the investor or lender that they are pursuing. But we have impact investing, which is really seeking that environmental and social impact first, and then looking at the returns. That's over 1.5 trillion US dollars right now. Then we have, let's say, a bit further, sustainable investing, which is still seeking those impactful impacts, but in a less first way. They're seeking it after they seek their financial returns. Well, that's between 3 to 4 trillion. Now, when you look at overall environmental, social, and governance integration in investing, well, that's over 50 trillion. And so that's far from being niche. That is mainstream. That is, roughly a third of global assets under management. And so when we look across the spectrum and we look at the trends, there's no stopping this because it just makes good sense. It makes fiduciary sense and it makes return sense.
Thank you for that perspective. Jenny, as creator of the Chartered SRI Counselor credential, how do you help investors navigate the complexities of various sustainable investing approaches?
Well, so there's a few things. I'm known for using a lot of analogies and metaphors to try and simplify some of these complex topics. And one thing that I like to do is look at the environment that we're currently in and break it down into something that's a little bit more relatable. So one metaphor that I like to use, and apologies, I relate this to food. And if everybody's hungry at this hour, just it's lunchtime here. That's the reason I bring that up. I look at the strategies. If we're going back to the concept of strategies in this scenario, look at sustainable investing like a cake. And look at ESG criteria, which has been a little bit divisive in the US, specifically as the eggs, flour, and sugar that go into baking that cake. So lately, you've seen the attention taken away from the final product, the sustainable investing strategy, and placed more on the ingredients themselves, which doesn't make a whole lot of sense. So at the same time, when we consider strategies, the arrangement of those ingredients, we result in something, when you rearrange those ingredients, you can result in a completely different cake. You can have a values-based approach, an integration-based approach. As we know, there's, different cakes can result from the rearrangement of different ingredients. So just as much, we can use different ESG criteria to arrive at different strategies. But in the end, they're all different, to each their own. But we still want to have a sustainable investing strategy in the end.
I always welcome cake analogies. So thank you for that.
You're welcome.
Loannis, what does your research reveal about the comparative long-term impact of various ESG strategies?
Yeah, that's a great question, Andy, and one has been asked several times in the past. So let me first draw an important distinction that we need to keep in mind. When we talk about performance, there's clearly the firm level performance. In other words, whether a particular firm is outperforming its competitors within its given context, usually the industry. And then we have the question of whether particular investment strategies actually outperform particular indices or other types of investment strategies. And in my experience, a lot of times when we talk about outperformance, people confuse the two, right? Because they tell you, for instance, a sustainable portfolio doesn't outperform because it might already be priced in. And it's like, and that's supposed to be an argument against sustainability. Because, and then I ask them, well, is the price of Apple already pricing in its innovation potential? Well, yeah, probably. Does that mean that Apple needs to stop innovating or stop doing what they're doing? Of course not. So we have to be absolutely clear that there's this difference. On the firm level, I think we have sufficient evidence that to the extent that sustainability and responsibility is strategically and truly embedded in the organization, then yes, those companies do perform better. And it's in my mind, is rather logical, right? If you have all of these rapidly shifting demands and expectations on the environmental and social front, and then suddenly you have a company that does better stakeholder management, addressing those risks and potentially exploiting the available opportunities, I mean, why wouldn't you expect them to do better? So at the firm level, there's, in my view, at least sufficient evidence to say done right, it leads to outperformance. Now, at the level of the portfolio, however, the results get more mixed because even though as we, in a sense, talk about these classifications, right, from ESG integration to impact investing to exclusions and so on and so forth, some clearly in their actual application, these differ quite a bit, right? Different companies may have different exclusion criteria. Different companies may use different data for their ESG integration strategies. So I would say that at that level, the results are mostly mixed because we do not have clear enough definitions. And even we had definitions, we don't have identical implementation of those particular strategies across the board in order to be able to compare apples with apples. So a lot of the times you end up having too much noise, and therefore you get too much noise in the outcomes. What I would say is that perhaps the more robust part of the evidence is the downside, is the shielding of the downside, is the better management of the risk, more so perhaps than the outperformance, at least at the portfolio level and across these different strategies.
Marilyn, your thoughts as a investment person?
I think the last point mentioned about how sustainability as a lens, as a filter, as a means to collect data and analyze that data actually protects against the downside is helpful and is accurate. We found that during the 2020 market downturns, those both at the firm level and at the investment portfolio level, those portfolios and firms were more resilient and did stay the course versus those that did not have that thesis at all and were ignoring sustainability and ESG metrics. They were hit harder. And so I think it is important to look at both the upside and the protection against the downside.
Andrew, are there any trade-offs or challenges that you've seen investors face? You're muted.
We're in a very unique moment in time where we have always been moving toward greater disclosure so that investors have more information to make better decisions. And what we're seeing now is a concerted effort to suppress information. So there's been laws that have been passed in 18 states that have literally made it illegal to assess risk and have made it so that companies that are disclosing are going to be, could be liable for some litigation, whereas investors are saying, hey, we want to have this disclosure so we can differentiate the leaders from the laggards. So when you have this, just the companies are between a rock and a hard place of wanting to disclose because they want to differentiate themselves as being better management teams, as being addressing risk so that they will be overweighted in portfolios. And yet the federal government saying, if you do that, we're going to harm you, we're going to punish you. So this is active data suppression, information suppression in order to try to just put their finger on the scale of the free markets. I mean, what Marilyn was saying is this idea of this shift from an extractive economy to a regenerative economy, this is the market forces are very strong moving that direction. I mean, it is a powerful push that they need to really try to stop the free markets. I mean, they're really actively trying to halt the free markets. So it's a very unique moment in time right now for investors because you got to make the right call, and you're trying to make the right call, and yet, we engage hundreds of companies. We sit down with management teams, and they're calling us and saying, like, what should we do? And we're saying, well, if there's an executive order that says you're going to lose your federal contract if you have diversity, which is not defined, that could be if you have a woman or a person of color on your board, we don't know, but it's being challenged through litigation. What's a company should they disclose right now? And we're saying right now you should probably try not to harm the company. We got to wait for this stuff to move through the courts. So we're in this limbo period.
Anybody else want to weigh in?
Well, I'll just weigh in and say, in order to be competitive, economically competitive as a country, as a subnational government, as a firm, as an investment manager, whatever level we want to take it, this lens is absolutely needed. And so we're seeing the growth, we're seeing the returns, and we're seeing the global majority move in this direction. Over half of the companies listed in China are reporting using GRI. That's the Global Reporting Initiative. That's the gold standard for comprehensive sustainability reporting across all the environmental, social, and governance metrics you can think of. So this is, again, not a niche, and the entire world is moving in that direction. Sustainability reporting is now part of what's required in Nigeria and Indonesia, South Africa, all of these high growth, really important economies across the globe. So I think there is a strategic choice right now. And do you want to be a leader and be economically viable, or do you want to just inflict harm on yourself, your own economy, and your own people. And that's the choice, I think, right now before the U.S. government.
If I may add to that, Andy, I think especially what Marilyn was saying about the global picture is absolutely fundamental, right? Because I do think that in the US, we have this phenomenon where clearly the vibes are louder than the reality, right? So Trump's election was not the by a margin largest election victory. The vibes were more than the numbers. I think therefore we should be careful when we talk about this sort of the backlash or what is happening in the US with respect to DEI, ESG, sustainability, to differentiate, as Andy said at the beginning, between the vibes and the actual reality on the ground. Because truth of the matter is, of course, as we all know, the election of anyone is not changing any of the underlying fundamentals, especially when it comes to the environmental and social issues. That's point number one. And point number two, I'm sorry to say this, but there's a whole wide, wonderful world outside the US that is not looking at the issues in the way that the US administration is looking at it. For instance, in Europe and in the UK, it's a matter of priorities. We had the Draghi report out. We know that we're lagging behind in terms of competition, in terms of productivity, in terms of wage growth. So for us here, the conversation, it's more about priorities rather than an underlying ideological war. If we go outside the Anglo-Saxon world and we go to Asia, for instance, in my view, for China, this is 100% competitive issue. The US is living a massive competitive gap, a leadership gap. And of course, China, whether it's green technologies or electric vehicles, you name it, of course, they're going to jump at the opportunity. Meanwhile, regions of the world, like the Middle East, they see it as a differentiation necessity away from the traditional way they were making their money through fossil fuels. Whereas for Africa and even Latin America, in some respect, it's a matter of justice, right? It's a matter of a just transition and therefore sustainable development with the help of those that have created the problem. So we need to, as investors, keep in mind all of these different underlying trends and motivations that are fundamentally different across different parts of the world. And that's precisely where geopolitics makes investment. We have entered, in my view, an era where it's the era of regionalism. And as we look at our investments, we necessarily, and at least for the foreseeable future, have a very regional lens in terms of understanding everything, including sustainability and ESG.
I just want to push back slightly because of, in Europe, and I agree. I mean, what I said before about that, this is, the market forces are massively moving towards sustainability and justice. But the forces pushing back on that, look at what happened with CSRD in Europe. So that's a reporting standard. That was, first of all, pushed back 2 years instead of having it apply to, I think it's like 80,000 companies. It's only going to be applying to like 10,000. So they've reduced the number, and also the disclosure is only going to go to tier 1, as opposed to, it was originally supposed to go all the way down to the supply chain to the source materials. So you've got a real, now, yeah, it's better than, it's still good, but what was intended was so much more comprehensive, so that literally the market forces, investors could overweight the companies based on disclosure, based on good data. So again, data suppression, delaying, this is happening across the world. And so it's something to be very aware of as an investor.
So can I respond to Andy? Because I was involved very much CSRD, ESRS. I was on the board of the institution that created the sustainability standards, or recommended the standards for the European Union. And I will say there is a bit of a global north, global south divide. And again, the global south is most of the world's population, the global majority, where most of the economic growth is, where also most of the emissions growth is, if you have a pollution or a climate perspective. And that is where I see the leadership. The first central bank in the world to do anything tangible for climate was the People's Bank of China, China's central bank. And they created a premium rate, or a preferential rate, for all of their banks who were doing environmentally friendly projects. A huge, but you're talking about 4% versus 1.5, 1.7% if it's a green. labeled solution or project. So I think the Global South is leading in on this. And, that is critical for supply chains, for investors, and so on. What we need to have happen now is for Global North investors to wake up to that reality and to properly allocate investments to the Global South. I'll give you one example. In 2019, the Jamaican Stock Exchange was the highest returning stock exchange in the world. Almost every year, it's an emerging market, Global South country stock exchange that is the highest returning. So if you are in the Global North in your retirement fund or equivalent, and you are not exposed, you're missing out on that alpha. Very little, if any, of the typical Global North investors allocate to the Global South. And that, I think, is a crime, both from a pure financial perspective and from a sustainability perspective.
Performance talks. Let's go to segment 2.
Sustainable investing relies on measurable data to assess impact and accountability. ESG metrics track a company's performance in environmental, social, and governance areas, helping investors evaluate risks and opportunities. Reporting frameworks like the Global Reporting Initiative offer broad sustainability disclosures, while the Sustainability Accounting Standards Board focuses on industry-specific financial materiality. The United Nations Sustainable Development Goals provide a global benchmark for aligning business activities with social and environmental priorities. Transparency is critical, ensuring investors can verify claims, compare performance, and hold companies accountable. Challenges persist, including inconsistent data, lack of standardization, and difficulty in quantifying certain impacts. Reliable ESG data sources include sustainability reports, rating agencies, and industry organizations. Establishing clear measurement tools strengthens credibility, helping investors differentiate between meaningful impact and marketing-driven greenwashing.
Jennifer, what are the most effective tools investors can use to ensure impact claims are genuine and measurable?
This is a good question because throughout the industry, there really are tools that are emerging still as being refined. Most data providers are still looking for ways to refine their existing offerings to the broader public. I would say that the invention of ESG ratings and scores were both a blessing and a curse for our industry. Because on the one hand, it got so many firms using the data and talking about sustainability and impact than it had in the past. But on the other hand, it caused some complacency among those that use the data purely for the headline number and not the substance behind it. So in other words, it's not understood that the ESG scores and the data can be used to identify symptoms of a problem, but they can't outright diagnose what the problem is. It takes that analysis to thoroughly identify and diagnose what a problem is, because much of the time the issue is really related to something that it takes years to manifest as an actual disaster that's going to happen in the future. And many of the data providers today will, have all these indications that something will very likely happen at some point in the very far future. Now, it's one thing for a fund manager to diagnose what a problem is and then walk away, as in divesting from something. It's another thing to diagnose the problem and then treat that problem so it doesn't become a bigger issue or turn into a disaster for stakeholders or shareholders down the road. So fund managers who work with organizations like Andy's As You Sow are really true sustainable funds because they set themselves apart from the rest. So that's a tall order for many, but we'll continue to see greenwashing in the near term until we see some that find a way to refine those tools, I suppose. But
Andrew, in this period of limbo that we're in, and you're somebody deeply invested in transparency, how do you evaluate the reliability of corporate ESG disclosures?
Well, As You Sow publishes between 6 and 10 original reports every year. So we develop our own key performance indicators, and we have our research teams actually dive into the data, talking to the companies, putting out surveys, of course, looking at whatever sustainability reports they're putting out. Sustainability reports are getting a little thinner right now, we're finding, but ultimately it comes down to relationships. And this is one of the things about the quality of data, because you look at, some of the big data houses, the MSCIs, the Sustainalytics, and they're using AI and just scraping up massive amounts of data, but they're scraping up a lot of garbage. And a lot of companies, for instance, on climate change, their disclosures are not only inaccurate, they are intentionally misleading. And so once they gather them up, they put them in their database, and now because it's in a database, it's supposedly fact. So what I would say is you should be looking at what are your data sources. We've actually, a whole bunch of asset managers and folks approached us and said, we want to actually license as you sow data for portfolio management. We actually spun off a for-profit group called asyouKnow.com that gathers not only our data, but data from all these other nonprofits and aggregates them into a database that's very high quality data and licenses it out. And then we distribute the license fees back to the nonprofits, and we all use it to maintain the data and actually expand the coverage. And we're able to look at like racial justice and DEI data on 3,000 companies every quarter because we have our team doing it. We have humans doing it. So data quality is very, very important, and people should be very careful about, what the data that they're using and what they're assuming is fact, and to get, I would say you want to get multiple sources and then compare and say what's really going on.
Marilyn, you spoke about Sustainability Accounting Standards Board. How do frameworks like that or sustainable development goals, how do they influence your approach to aligning capital with measurable climate solutions?
So I think I spoke about GRI, the Global Reporting Initiative, and they're comprehensive across sustainability. And I would say they're really important because they provide not only the overall framework, but the specific key performance indicators, the specific measurements that are required for a vast number of sustainability attributes. There's something that we supported at the very beginning of its life almost, which is PCAF, the Partnership for Carbon Accounting Financials. Now that is one slice of the pie, but a really important one, which is standardizing the methodology to account for emissions for financial institutions. So if you're a bank or asset manager, what are you financing in terms of greenhouse gas emissions? So for your mortgages, for your auto loans, for other financial asset classes, what's the number behind that? And how is that number shifting over the years? And are you creating new products? Are you creating, for example, an EV auto loan product that will attract more customers so you can actually begin to change and shift what that number looks like in your portfolio? And so that is something that is bringing accountability to the financial sector in a way that would not exist, I don't think, without that kind of measurement and disclosure. And GRI, the Global Reporting Initiative, takes things like that, times 1,000 across a number of ESG areas, including water and land use and a plethora, human rights, a plethora of very important sustainability issues.
Loannis, have you observed any notable gaps between reported ESG performance and actual corporate behavior in your studies?
So if you allow me, Andy, to take a step back, I have a slightly different approach towards ESG data. If you allow me to share it, and then I'll answer your question as well, because yes, of course, inevitably, there is usually a gap for several reasons. Of course, greenwashing is one, greenhashing is another, but also the underlying complexity of the issues, plus the fact that these issues evolve very quickly on the ground. So the measure, unless it's a real-time measure sometimes, cannot fully capture what may be happening. But what I want to highlight a bit, and I've written an op-ed about this recently that got a bit of a backlash, but I'm going to say it anyway. I think that everything that we've been discussing is absolutely brilliant. If if we look at the evolution, the development, the quality of this ESG data in the last 10 years, it has the progress we have achieved has been absolutely amazing, especially if we consider how complex the underlying issues are that we are trying to measure, right? Having said that, though, and we have laws and regulations and reporting standards and voluntary and mandatory and so on and so forth. My argument, though, is that those are necessary conditions. In other words, that level of transparency is necessary, but it is not sufficient. Why is that the case? Because I wrote in my op-ed that we have developed a robust technical infrastructure, whether it's reporting standards, acronyms, associations, even laws and regulations. But at some point, and this is a reflective sort of moment, but at some point, I think that we ended up only talking about reporting, only talking about disclosure, as opposed to understanding the underlying strategic action or behavior that you asked me about. And that did create a gap. But that gap ended up being fatal for us. Why? Because what did we miss? We missed the narrative infrastructure, telling the story, the evidence and data-driven, but still the story of how that level of corporate action and accountability actually addressed the issues, actually spoke to the problems of the relevant communities, whether it's local communities, indigenous people, trade unions, the employees, and so on. And guess what? Because we left that gap, the other side came in and occupied and redefined for us, without us, what we do. ESG and sustainability is about taking away your SUVs. You're not going to be able to eat meat anymore. You're going to lose your jobs, and so on and so forth. And it's the drill baby drill storyline that, by the way, it's also fact and evidence free. And if you're fact and evidence free, it's very easy to create a story. So my argument is that in order to align, right, the two, we need to, and perhaps this is a moment of reckoning of the entire movement, right? We need to understand what is the narrative story that we are going to marry with the robust technical infrastructure in order to ultimately have that impact. And in this case, by the way, and I hope we get to discuss this, in this case, impact does not mean, in my humble opinion, being profitable or creating alpha within the current system. I think having an impact goes back to what Andrew was saying. It's about reinforcing those market forces that are moving towards sustainability, that are moving towards regeneration in a way that ultimately changes the system, in a way that ultimately aligns at least this version of capitalism that we have to function within the planetary boundaries and recognizing the social inequalities that we face. So for me, that's what we need to be doing as we think about not only aligning corporate action with disclosure, but rather aligning corporate action with the ultimate destination, which is a system that works within its limits, and telling a positive narrative story based on that evidence that creates this alliance of all of the stakeholders that ultimately can move the system. Because investors and companies alone, even sometimes with regulators, they cannot move the system unless you bring the big mass of people and constituents with you.
I think, if I could jump in, I think what we're talking about here is time horizon. And I agree with everything you're saying, but if you look at a longer time horizon, and most investors do. Most investors are in a pension fund or retirement fund. I mean, it's the vast majority. A totally collapsed ecosystem, a collapsed economy is not going to be good for anybody long term. So I think, but we're sort of stuck in this Milton Friedman macroeconomic idea of externalize your costs, abuse your employees, just try to squeeze every nickel out of the system in the short term, as opposed to like a Joseph Stiglitz macroeconomic theory, which says you got to look long term, let capitalism serve all the people and not just a few oligarchs. And so that's, I think, the moment that we're in. But if you again, it's really looking at time horizon. And I believe the vast majority of investors really care about long term. And that's, I think, maybe that's part of the narrative you're looking for.
I agree. And I guess I would add to what you just said is that some of the structural forces in the current system prevent the long-term thinking, right? And I'm saying that, this is the sort of the political economy that we need to shift that narrative, because ultimately capitalism, both versions that you described are narratives, right? These are man-made systems. They depend on laws and regulations and our understanding of what is value and what is valuable. So if we need to start changing those fundamentals to ultimately change the system, because of course it's the long term, but the question is, how do we get there? Right, especially as you rightly described, you face so many inertia towards the current system.
But forced inertia. I mean, you got oil companies that want us to continue to drill, even though there's no demand for their product, even though the internal combustion engine will be obsolete in a matter of a few weeks. It's like that's what it is. Yeah.
Thank you. I love the time horizon. And this is not a situation where companies are checking a box. Are you ESG focused, yes or no? It is a continuum, and it's got to be action focused. What are you doing to move things forward? Let's go to segment 3.
Sustainable investing has shown competitive financial performance compared to traditional approaches. Companies with strong environmental, social, and governance practices often demonstrate resilience during market downturns and may outperform over the long term. ESG factors contribute to risk management by identifying vulnerabilities such as climate risks, regulatory shifts, and reputational concerns. Sustainable funds also benefit from increasing investor demand, driving capital toward companies prioritizing sustainability. Financial upsides include innovation, efficiency, and access to new markets. However, challenges exist, including greenwashing and evolving ESG standards. Investors can assess performance using ESG ratings, fund comparisons, and financial analysis from reputable sources. While sustainable investments do not guarantee higher returns, data indicates they can enhance portfolio stability and long-term value. Careful evaluation is essential to distinguish between genuine ESG performance and marketing-driven claims.
Loannis, what empirical evidence most persuasively supports ESG outperformance theories?
So, and as we were discussing earlier, I think that we have at this point in time literally decades of studies and thousands of studies that at the firm level that one way or another do confirm the outperformance. However, I need to caveat this in many ways, because people treat this question about does it or does it not outperform as sort of the holy grail of sustainability. And for me, that's a mistake. So first of all, one needs to understand that what we do at business schools, in management more broadly, is social science. It's not physics. It's not that we are uncovering a law of the universe that applies forever and under all conditions and under all time periods. No, we're dealing with humans. We're dealing with social context, laws, regulations. The sentiment of the market changes. So we need to take all of those into account. And by the way, this question about outperformance, I mean, it cannot be framed in simple terms. For example, we spent the entire 70s and 80s, you know what academia was doing at the time? Reacting to what was happening in the markets. They were saying, does diversification pay? Right? I'm not sure some of you may even remember those debates, right? And guess what? It's social science. It's yes, it's no, it's maybe, it's U-shaped, it's otherwise shaped, and then people said, wait a second, we should be more sophisticated, right? What kind of diversification? Related or unrelated? And now we're talking about the product level or the resource level. So after we pose that big question, we need to become more sophisticated. And ultimately in social science, of course, it's going to be contingent. And contingent on what? Well, in this case, it's about, did you, for instance, if you're a business, did you work on material ESG issues or not? Because that's going to make a difference, for instance, right? So were those material factors sufficiently integrated into the commercial side of the business, for instance? And I think that we are, in other words, what are the pathways through which a sustainability commitment actually translates into performance and then potentially outperformance. And that's what we are currently understanding even better. For instance, does sustainability afford you preferential access to financial capital? Does it afford you preferential access to human capital? Does it enhance your social license to operate? Can it deepen your customer relationships? And does it allow you to retain, engage, and have more productive employees? For me, that's the questions we should be looking at. And clearly, not all of those mechanisms are going to be relevant for all companies. For some companies, they might create value through human capital. Other companies might create value through the social license to operate. So what we should be asking is not the general, and that's the whole idea of investing in this space, in my view. That's why, not just the ESG data sets, but going and visiting these companies and telling them, articulate to me, how is it that your so-called sustainability commitment is enhancing your business model? And tell me the precise mechanism through which that happens. Then, as an investor, I can say, well, that makes sense in that industry. That's better or worse than competitors, and then make that call. Right. And the last thing I'm going to mention is that I'm not the finance expert per se, but I do follow the finance literature in terms of understanding how is it that these different investment strategies fare in the long term. I think it's still early days, but the noise in, noise out concerns me a little bit, precisely because we might have theoretically good definitions, but we have a huge diversity of implementation variants in this strategy. So it's very hard, for me at least, to make a blanket statement about which strategies would always and forever, so to speak, outperform, because the underlying data has changed, the underlying exclusion criteria might be different, and so on and so forth.
Marilyn, what signals do you look for to identify climate-aligned investments with strong return on investment potential?
So I do think we have to break this down by asset class. There's something that we backed, an open access, free of charge database called climatesolutionstocks.com. And it has, for most of the world's economy, global north, global south, the list, for all listed equities that are available on all the different stock exchanges, what are the listed companies that are proposing climate solutions, both from a pure play perspective and from a revenue filter, exclusionary perspective. So does that company have more than 50% of the revenue coming from that climate solution? And that, I think, for the listed equity space, that's just very clear. And the methodology is open access. People can drill down. And I think that will be different for example, the fixed income space and bonds. So there's various sustainability guidelines for bonds, green bonds, social bonds, sustainability linked bonds. And I think, different economies will issue different kinds of bonds, whether they allow for project-based bonds like in the US or only, government-based bonds or general obligation bonds. And I think that it's, comparing a government-issued bond to a firm-issued bond, corporate bond, is very different. And the valuation criteria has to be different. It's just apples and oranges. And so are we looking at a venture capital fund? A venture capital fund for climate cannot be 10 years. It needs more patient capital, especially if it's focused on deep tech. So you have to take it asset class by asset class, and there's various resources out there to help bring that through. On the banking side, if you're choosing a bank or credit union, there are some basic exclusionary criteria. For example, does that institution back the fossil fuel industry? Have they signed up to the fossil fuel non-proliferation treaty? Are they disclosing their financial emissions, finance emissions via PCAF? All of these are concrete ways of deciding whether a bank or a credit union is aligned and is supporting climate action. There are a number of databases. B Lab has one for B Corp certified banks, for example. In the US, there's Green America that has a database as well. So the tools are out there, and most of them are open access.
Thank you for sharing those resources. Jennifer, you've worked with training financial advisors. How do you train advisors to manage client expectations around ESG financial returns?
Yeah, that's a tough one, because most of the time this is a valid concern, right? Many advisors don't want to risk having their clients be upset with them, obviously, from having expectations of returns quelled by disappointing returns from their, sustainable investing being not what it's supposed to be, or what it potentially could be. I say that, education goes a long way in this space, but also taking a look at some of the, or understanding also that they're not alone in this, issue of fears. That this is a common problem across many generational issues. Morgan Stanley has conducted many studies over the course of the years. Actually, since 2015, every 2 years, they've conducted a study of millennial investors to see that this is actually a concern even among them, and has perpetually become a concern among them regarding returns. But what Loannis mentioned, that this has been a concern actually back to the 70s regarding performance. There's actually been a meta-analysis that was conducted back in 2015 that took a look at over 2,000 separate independent studies on performance, and noted that with over 90% confidence, there was this overwhelmingly positive correlation between use of sustainable investing strategies and non-negative, is what they noted, financial returns. Now, we know that correlation doesn't equal causation. So all that tells us is that there's a strong positive relationship between the two things, but we don't know in what direction those two things flow. So what I tell advisors is that you need to tell your clients that there is this strong positive relationship that should be conveyed to clients, but to make mention that, and it helps to know that you're smart in this instance, to note that the returns, it's just to note that the returns imply that there could be a good use of sustainable investing strategies. At the same time, it could also imply that the use of a sustainable investing strategy also leads to good returns. What I would argue is that it doesn't really matter what direction you're moving in, because the end result is still the same. It's good. We've known for almost 200 years at this point that using good corporate social responsibility will help companies last for decades, and just ESG is another repurposing of that concept, but more broadly. And so good companies mean good returns. It's really that simple. And so having that knowledge to be able to convey that to their clients is really powerful.
Andrew, in your experience, what role does shareholder advocacy play in unlocking financial returns alongside social returns?
Well, I mean, shareholder advocacy is really, it's really about oversight. I mean, the board has oversight of management. Shareholders have oversight of the board. That is how capitalism works. That's how, property rights work when you own a share of stock. And so by having good oversight, by having just more brains in the room, and a diverse set of brains, you can generally foresee a lot of risk that might not be seen by a smaller group. So I think ultimately, shareholders are there to help their companies. When we do research and we say, we find a company is a leader and one's a laggard, and we sit down with the laggards and say, look, this is your direct competitor and they're just doing better than you on whatever the issue may be. It could be regenerative agriculture. It could be racial justice. It could be climate change. We're offering them a solution. We're saying, look, this is what they're doing. Here's the ROI. Here's the return on investment. The cost of matching them or doing better than them is less than if you do nothing, you're going to have potential harm. And so we're just helping the companies to reduce long-term risk for all stakeholders, to increase a long-term sustainable growth. And again, it's this time horizon thing. We're also getting them to say, look, at the long term. We looked at your stock, we look at who owns the stock. We're looking at your at the actual data set, and 85% of your investors are pension funds, are long-term holders. 15% are day traders. Are you going to make your most important strategic decisions based on that small 15%, or are you going to actually listen to the folks who care about you? And I think that's why we have really good relationships with the companies. I mean, a lot of people, the press, they like to say, oh, the resolution, it failed or it passed. There is no pass fail. These are non-binding resolutions when we even escalate. And that's another thing people don't realize. We engage a couple of hundred companies every year. Most of them say, thank you for taking the time and the effort to come and talk to us. You've helped us become a better company. Then there's the ones who are really resistant to us and say, we don't want to hear from you. Those are the ones that we file the resolutions with. So what you're seeing, if you're only, and most people perceive us as just filing of these resolutions, that's a very small percentage. And those are the most resistant companies. And then once we file, most of them say, hey, if you're right, this is a really good point. If you withdraw, we'll go do it. And we'll say, cool, we'll do that. So again, you've got another small subset that actually go to a vote. They're the ones who are just saying, no, we don't want to listen to our shareholders. And we're like, but we're here to help you. We're your friends. And so there's a perception that it's like this, but it's this because we own the companies. We are the companies. And so it's very collaborative when the vast majority of it is incredibly collaborative.
Very encouraging. Just thank you for that background and the collaboration. Let's move to segment 4.
Greenwashing misleads investors by presenting a company as more sustainable than it truly is. Tactics range from vague claims and selective reporting to inconsistent practices that do not align with public commitments. Red flags include a lack of data, unverifiable ESG claims, and discrepancies between marketing and operations. Corporate accountability depends on strong governance, independent oversight, and transparent reporting. Investors can research fund legitimacy by analyzing ESG ratings, reviewing sustainability reports, and verifying claims through third-party assessments. Tools for accountability include shareholder engagement, proxy voting, and shareholder resolutions that push for better ESG performance. Legal action can also be taken in cases of fraudulent claims. Ethical dilemmas arise when balancing financial goals with sustainability priorities. Careful scrutiny is necessary to differentiate meaningful corporate responsibility from misleading marketing strategies in ESG investing.
Andrew, as you sow has been mentioned several times on this podcast since you were on last time. How can everyday investors better scrutinize fund labels to ensure alignment with their values?
When you say fund labels, you're talking about mutual funds and ETFs?
Yeah.
Yeah. So we have a platform called Invest Your Values. You can go there. It's open to the public. It's free. investyourvalues.org. And what we do is we look at 6,000 mutual funds every month because they change their holdings. And what we developed this in 2015 because what we found is there are all these people who wanted to divest fossil fuels. They wanted to get away from the risk, the climate risk. And yet nobody knew what they owned. So people came to us and said, I want to divest, but I don't have a clue. I mean, there's 100 million people with $10 trillion in 401k plans, don't have a clue. They're in the Vanguard fund and they got no idea. It's got a bunch of Vanguards in it. They don't know that it's actually as an index that holds the entire extractive economy. So what we did is we just put up this site, and what it does, it looks at every mutual fund or the big ones, and it says, okay, what's inside of it? And it identifies these are fossil fuel companies, these are oil companies, these are utilities, and now you know. These are private prisons, and we believe private prisons are really a proxy for racial justice. It's a manifestation of racist policy. We look at all these different issues, gender equality. We look at weapons. We found that school teachers didn't want to have assault weapons in their portfolio after these massive school shootings. Well, now they could go to a site and they could see. Now, the problem is when you're in a 401k plan, there's not a lot you can do about changing it because essentially they're all the same. I mean, we also have on that site, you can look inside the 401k plans. I think we're up to about 70 companies. We'll eventually get the whole S&P 500, but you can look inside Amazon if you're an Amazon employee and see exactly what's inside. And we're down to we go really deep. And again, we update it once a month because the holdings change, but we're also looking at what percentage of it, and who's in what are called the QDIA, or the default option. And most people are in this default option, these indexes. And by the way, there's this new executive order that just got put out a couple of weeks ago saying we need more risk in our 401k plans. We want to add private equity and we want to add crypto. And so this is a really dangerous thing. There's so much risk in your 401k plan right now because you're so heavily invested in fossil fuels, heavily invested in the extractive economy that's in the process of winding down. And now they want to add more with even less transparency, because you're in private equity, you don't know. There's no rules about disclosure. So we're about to enter this, let's add more risk to everybody's portfolio. I don't know whether I answered your question, but we try to help people just to know what you own so you can then decide what you want to be invested in, because your money, it really defines the future. And just if I keep going a little bit, there's also this issue around proxy voting. When you are in a 401k plan, you're handing off your right to vote. You have a right to decide who's on the board of directors of every company. And you've handed that to Vanguard. Vanguard votes 100% of the time with management. BlackRock votes 98% of the time with management. And so what we're doing is we're trying to get people to become aware of this, to demand what's called pass-through voting, which means you get to say, I want my fractional shares to be voted in this way. Now, the big asset managers have offered some options. Again, not to pick on Vanguard, but they have offered 5 options in their voter's choice. 4 of them are identical. 4 of them are vote with management 100% of the time. They have one called Glass Lewis ESG, which is a little better, but even that one, it supports board directors. I think it's 85% of the time. It endorses CEO pay packages about 90% of the time. It's better on the shareholder resolutions. But if you want to vote against the board and you're in a 401k plan, even with pass-through, there's not a lot of options. Now, we're trying to get them to expand that to actually offer a truly sustainable voting option. We call it As You Vote. We publish this every year. And I believe State Street is now incorporating that.
That's great. Thank you for the resources and that background information. Jennifer, what red flags should investors and advisors look for when analyzing fund sustainability claims?
Oh, this is a good one. So actually, before coming into this role, I worked for an ESG data provider that was known for being 100% transparent with how the scores are calculated. In fact, that's why I chose to work for them specifically. And one issue that I encountered with some of the fund managers that would come to us is this fear of looking bad when they have a fund that they are very proud of that they've constructed regarding sustainability. And one thing that Loannis brought up previously, I think a few questions ago, and this stuck with me, was the difference between returns and impact scores. And I think they conflate the two just a little bit. So you could have a fund with fantastic returns and one that is very different regarding impact. And when they want to have, showcasing both things at the same time, if you see a fund that, great returns, everything like that, they want at the same time to showcase a impact score that's also equally something to be proud of. Now, if they, are labeled as a sustainable fund and they come and they have a sustainable score that's something ridiculously high on whatever scale it happens to be, they sometimes will, the fund manager, I'm referring to they in this case, will, sometimes try and tout their score if it's above or near 100% in whatever, range or scale they happen to be comparing that to. I will note that in this particular data provider that I worked for, it is impossible to get a 100% score in any in this system. It just is. No company or fund will ever come close to that. And it frustrated many fund managers that would come to us and want to, understand why they couldn't get to this point. So, it's just a fact of life that you could see that there's something to strive for in terms of fixing and working towards sustainability, and recognizing that there's never going to be a fund that is just completely perfect. Now, I know that investors will look at that and say, well, I want to invest in something that's perfect, that is completely sustainable. And that's challenging for them to comprehend. Now, when you change the scale in some capacity, maybe that gets them to maybe lessen their stance a little bit. But on the one hand, it's the red flag there is just perfect score funds regarding sustainability are just going to be difficult to come across, more broadly speaking. And it just exacerbates the greenwashing argument even further. So I'd say that this is just something that we need to address more broadly in as an industry.
Loannis, when it comes to corporate accountability and greenwashing, do ESG rating methodologies need an overhaul? Why or why not?
Yeah, great question, Andy. Let me start by saying that, again, a little bit of an unconventional view, but there's always silver lining. I think that greenwashing, of course, with all its negatives and so on, it does contain a signal. And for me, the signal is that these companies or these funds feel sufficient pressure to lie to us about what they're doing, because indifference is the enemy, right? Because if these issues that we are talking about here today did not matter, none of these folks would feel the pressure to lie to us about what they're doing. So there's a silver lining. So I use greenwashing almost as a measure of, is there sufficient pressure at this point for these folks to appear to be responsible or sustainable? Now, having said that, I want to bring in another dimension that I hope it also answers your question, Andy. I tend to believe that precisely for the reasons that Andy and Jennifer were just describing, in other words, all of these pathologies in the current system of asset management, in terms of really, linking people's preferences, values, and objectives ultimately to their pension savings, their savings, or the way they invest their money. Exactly because of all those pathologies, I would dare say that this industry is ready for disruption. Someone may come in and do these a lot better and a lot cheaper and more accurately, meaning closer to the values of the people, ultimately the people that hold the money. And I think that we are already seeing that, especially if you see all of these, fintech, the proliferation of fintech, but also the engagement of the younger generation in terms of their demands and expectations, wanting to know, in the same way that they want to know what it is that they are consuming and what they're buying and what are the companies they're buying for. I think that we see that trend as well. We see the younger generations wanting to know the banks and the financial institutions and the savings account, wanting to know how they do this, and in fact, use that as a lever to express those values. If we are being honest, the truth is, the honest truth is that the current structure of the asset management industry, it is not designed to actually reflect the values, the preferences of individuals. It doesn't even have the capacity to do so. It's just too expensive for them, right? And therefore, that's why we're even now speaking about, as Andy was mentioning earlier, how do we, allow the people to express their preferences when it comes to voting and what's in their portfolio? Because these systems were never designed to serve that level of an investor. And that leaves a huge gap. And we already see, and I have already seen, fintechs and other companies talking already about asset management as a service. asset management as something that works in the cloud is a lot more cheaper. It's a lot cheaper, right? So we see even the evolution of quant investing with the integration of AI, of blockchain, and so on, which dramatically brings down the cost. And I think what we need to realize in my conversations, at least with the industry, is that this is not just an ESG issue. This is not just a sustainability issue, because once you crack the code in terms of reflecting people's preferences and values, it could be any, right? You might have different ones than me. I mean, even within sustainability, I may care more about the environment. You may care more about social issues and so on and so forth. So ultimately, this industry is ready for disruption, for that sort of those actors that will be able to get us to that level of reflecting those values. And therefore, to answer directly your question, I think that once we get that apparatus in place and that infrastructure is ready to reflect our values, I would dare say that that infrastructure would also be a new level of transparency with respect to all the issues we discussed. What's in my portfolio? How am I voting? How are my views expressed in voting and so on? Necessarily, because that's the whole point of this. So,
the technology is there. I mean, the technology exists. It's just a matter of there's so much fear and defense of the status quo.
Well, of course.
Looking at the indexes that we're forced into, everyone is forced into, all the pension schemes across in the UK, all across the world, these are all being forced into forcing our money to support the existing infrastructure, the status quo. And if you think the world is perfect right now, well, that's what you're invested in. We're all invested in our own destruction and we have no choice. Yet the technology exists to give us absolute total freedom to actually shape it according to our values and to then send our message to the boards of directors of all the companies of what our values are. This is not a technology issue. This is the old system, the extractive economy that is winding down that I keep referring to is just clawing and scratching and trying to change the laws. I mean, the US is, desperately terrified of actually having freedom of choice.
Yeah.
Let's bring it home and go to the last segment.
Sustainable investing is evolving with advancements in data analytics, regulatory shifts, and changing investor priorities. Climate risk modeling is improving, offering more precise assessments of physical and transition risks. AI-driven ESG analytics enhance data accuracy by processing large volumes of unstructured information, identifying trends, and automating reporting. Regulatory changes are also shaping the space, with governments implementing stricter ESG disclosure requirements and frameworks to improve transparency. Greenwashing regulations are becoming more rigorous, ensuring companies substantiate their sustainability claims. Investor demand continues to grow, pushing companies and fund managers to integrate ESG factors into decision-making. Impact investing is also shifting, with a stronger emphasis on measurable outcomes and accountability. As data improves and regulatory standards tighten, sustainable investing is expected to become more structured and mainstream, influencing corporate behavior and capital allocation in the coming decade.
Andrew, what's your vision for the evolution of values-aligned investing for the next 10, 20 years? Will there be a revolution?
I think there'll be an evolution. I think that the mass of people are realizing my money is my power, and I don't like the direction that we're going right now, that we are ignoring risk, that, just climate change, just, social justice, all these issues, that people actually are shaping a vision of what the world could be. And they realize that if you capitalize that vision, that's what becomes reality, and that your values can actually become manifest. And people are realizing this. And technology is now catching up. There's new startups that will allow you to customize your proxy voting, for instance, down to the T. And we do it. What's interesting is we offer this thing called My Money, My Vote at no cost. And it's for people who just own shares directly of companies. They get a proxy ballot into their inbox, and they look at it and go like, I don't know what to do. And they just don't vote. So literally throwing away their mail-in ballots. they can opt into a sustainable policy that we put forward, and you can, with one click, you can now vote all of your all of your ballots with one click. And instead of getting this email saying time to vote, you get an email that said thank you for voting, and you open it up and says any adjustments you want to make, any customizations. If you like we're voting against any CEO pay package where a person makes more than what the average worker makes in a century. We think that that's adequate. But you might say, you know what, I think they should make more. You can slide the dial. Literally, it's like dragging a little dial and shift it to whatever you want. So people are realizing, whoa. And so gathering that's a lot of power that people are throwing away because they didn't even know they had it. I mean, that's the thing. People abdicate their power without even knowing they have power. And now when they become empowered, it shifts the whole dynamic.
So definitely Google as you vote. It'll send you to asyousow.org, and you can find those resources. Jennifer, how is USSIF preparing investors for new standards and evolving definitions of sustainable investing?
Yeah, I will say, to be fair to financial advisors and many professionals, I feel like the industry hasn't made it easy to adopt good practices when it comes to sustainable investing. I feel like we've said, it's not as easy as here's some square pegs, here's some square holes. We basically said, here's some square pegs, now go find some holes that they might fit in and let them do as they will. But we really need to give some context and some best practices to help people understand. And, there will be mistakes made, but we need to help them understand that they need to be unafraid of this industry. It really is important. And for all of the reasons that Andrew just highlighted as well. So USSIF is actually putting together a 3-part roadmap series for financial advisors. The first part is set to release on September 3rd. It's free to download. And so I really hope that you will go do that, ussif.org. And really, this is designed around financial advisors specifically, but really anyone can benefit from this, especially if you are a client working with an advisor. This can certainly help you as well. And there really are 3 types of advisors: those that don't need convincing, who are already in this space; those that will never be on board. Obviously, I won't waste my time with those, but those that are deemed to be what I deem the movable middle, who can be swayed one way or the other and really need the right resources and support. That's my mission for the next few years, is to bring as many new people into the field as possible. And I feel like this series will be a one good step to do that. So hopefully that'd be good for you.
Loannis, you mentioned fintech. How will AI, or how can AI and machine learning reshape ESG assessment in capital markets?
I think fundamentally, Andy. So first of all, as we were just discussing, it actually enables new business models, and that's over and above all the other things that we discussed in terms of, for instance, it can actually help us with finding greenwashing in reports, right? It can audit these reports. It can actually, an AI can audit the data gathering effort of another AI. And we already see startups that do this. So not only do they give you a score on any ESG dimension, but they give you a quality of that score, so you can calibrate how reliable or unreliable that score is. So I think that everything, in other words, from portfolio construction to data quality and audit, all the way to business models for fintechs and everything in between, I think AI has a huge potential to fundamentally change the asset management industry. But we need to also, of course, be careful when we talk about, these technologies. There is, as I'm sure all of you know, a huge discussion in terms of, well, what is the environmental cost that we are paying for these technologies, right? So in other words, what is the energy usage, what is the water usage, and what is the impact of data centers on the local communities. And one thing that we should not forget, by the way, and it's very important, is that we are in a very privileged part of the world. There are hundreds of millions of people that do not have access to electricity, and there's almost, I think the last estimates that I saw, there's billions of people that are not connected to the internet. So we need to be acutely aware that using these technologies without accounting for the fact that a large part of the population and a large part of the world is not able to access these technologies might actually increase rather than decrease some of these inequalities. So as always with new technologies, it will come down to the type of governance and guardrails that we put around its adoption to make sure that we do not worsen, and in an ideal scenario, we actually improve upon some of these inequalities, especially when it comes to how do we integrate ESG. And previously, we also talked about the gap between the global north and the global south. Perhaps these technologies can help us elevate the level of transparency and the sheer volume of data that we can process so that we are more inclusive in that respect of our investment strategies.
Andrew, any closing thought?
Yeah, I just think we're at this, a really incredible moment in time where we are in this great transformation. I think this is a transformation like the scale of the Industrial Revolution, and what you're seeing is the pushback is so intense that it's become like part of the political landscape, and it's global. It's across the world. But ultimately, I think the market forces will win out. I think that you can push back. It's like it's a ripple that's become a wave that's becoming a tsunami, and that people have a vision of the future. They know that it's connected to their money, and that this is something I know people are very pessimistic right now. I'm actually very optimistic that this is inevitable, that this is what the market forces are actually doing, because as was said earlier, we got to look at the whole globe. It's not just the United States. And the U.S. is isolating itself, and that is ultimately going to lead to the downfall of empires do come and empires do go. But I think the global economy is going to look out for itself, and so it gives me hope.
Well, thank you, Andrew, Loannis, Jenny, and Marilyn. Appreciate our incredible panel for such insightful perspectives on sustainable investing, and I think a very optimistic view, very inspiring view. One of my favorite takeaways from today's conversation is how impact investing isn't just about doing good. It's about making your financial goals and your values work together to create real measurable change. And the balance of purpose and performance is truly where the future of investing lies. Now let's inspire you to do one action item to move the needle this week. Take a moment to review your own portfolio or investment choices and ask yourself, how well do they align with your personal values? Even small shifts can make a big impact over time. If you haven't explored sustainable investing before, start by researching one company or fund that prioritizes environmental or social responsibility. Many free resources were shared on the program today. And if you found today's episode valuable, please subscribe, share it with your friends or family, and leave us a review to help others discover this important conversation. A few things before we part ways. Let's connect on LinkedIn. Find me by searching for Advisor Andy. Inspired Money is created and produced by me and Bradley John Eaglefeather. Bradley's behind the scenes during the live stream and edited our segments. Chad Lawrence does our graphics, animations, and editing. Last but not least, I want to give a big shout out to our amazing guests who have shared their time with us so generously. Go follow their work and keep learning from the best. Andrew Behar is CEO of As You Sow and author of the Shareholder's Action Guide. Explore his impactful shareholder advocacy is at asyousow.org. Marilyn Waite, who dropped off, I think after around the fourth segment, she leads the Climate Finance Fund and authored Sustainability at Work. Discover her insights and work at marilynwaite.com. Jennifer Coombs heads content and development at USSIF and created the Chartered SRI Counselor Credential. Learn about her work and USSIF at ussif.org. And finally, Loannis Loannou is Associate Professor at London Business School, sharing groundbreaking research on corporate sustainability. You can find his work and courses at loannou.us or at the London Business School website. Anything that our panelists want to share or plug specifically? No, keep an eye out for USSIF's videos and campaigns ahead. And thank you, Inspired Moneymakers, for joining us today and inspiring us to invest with purpose and impact. Inspired Money returns next week, Thursday. That's August 21st at 1 p.m. Eastern. Our topic will be the science of happiness and financial well-being. It'll be a great discussion. Until next time, do something that scares you, because that's where the magic happens. Thanks, everyone.